What is happening, investors? It is your boy Jack, and welcome to today's video. Lately, I've spoken a lot about these high risk, high reward stocks. I've spoken a lot about Carnival Cruise Corp, about Delta, about Nat, and loads of other high risk, high reward companies. They're all really interesting and exciting, but today we're going to go back to my roots. I am a long-term dividend investor. They're the stocks that take up 90% of my portfolio. So today, I'm going to share with you what I deem to be 5 of the best long-term dividend investments that you can make. And on top of that, every company we're going to speak about today has released their Q1 earnings, so we can actually see how they've done this year. But guys, right before we get into that, I am on 1,890 subscribers. I would really like to get to 2,000 subs. Please, if you're not a part of the family yet, hit that red button. Join us. Let's get to 2,000. If you are a part of the family, thank you so much. Tell a friend, tell your granny, tell somebody to sub to the channel. And of course, make sure to smash that like button because that will help more people see these videos. I want you guys to let me know what your favorite long-term dividend investments are right now in the comments below. And one more thing, I'm actually thinking about setting up a Discord for everybody who watches this channel so that we can all just kind of chat about what stocks we're watching. So if that's something you'd be interested in, let me know in the comments below as well. Now though, with all of that out of the way, let's get into the very first stock of the day. I am now in my t-shirt, it is very warm, and we are looking at stock number 1, which is going to be Pepsi. Now, I've spoken about these guys on the channel before. I have boldly compared how safe they are to Johnson & Johnson's and Procter & Gamble. I know it's a little bit spicy, but I really love these guys. So we're looking at a company with a dividend safety of 93, a current dividend yield of close to 2.9%, and an uninterrupted dividend streak of 47 plus years. So right off the bat, from a long-term dividend investor's point of view, that is what you want to see. And every company we talk about today, actually, I am invested in, so I will throw that on the screen for you to see right now, just so you know I'm not spoofing around. Pepsi, on the 3-month chart, are only down 6% pretty much, which in the grand scheme of things, considering everything that's going on in the world right now, considering there's still a lot of companies down 30 to 60%, fantastic. And we go over to the 5-year chart and we can see that it's been a very nice 5 years. There's been some absolutely immense steady growth, and they're still up 41% in the 5-year chart, whereas a lot of companies are still in the red, so quite nice thing to see. So the main points of note from Pepsi's Q1 2020 earnings is net revenue growth of 7.7%, an EPS change, however, of -4%. And that net revenue growth obviously sounds fantastic, but they are actually making less money year on year. So we can see their net income is actually at 1.35 billion, whereas last year it was at 1.42 billion. Definitely not the worst Q1 that we're going to see this week though. They're still quite clearly doing okay. You know, they're still bringing in an awful lot of money, they're still profitable, they're still selling an awful lot. And we can see that they're in quite a good position because the company is not suspending its buyback program or cutting its quarterly dividend. So if both of those things can keep happening, obviously the company is not struggling that badly. And one other point of note is in March, Pepsi announced that it agreed to buy Rockstar Energy in a deal valued at 3.85 billion. So this was in March. They were completely aware of the situation that's going on, and they're still able to go out there and buy this deal with Rockstar. A lot of companies right now are just trying to survive, but Pepsi is not one of them. They want to keep growing, they want to keep controlling the market, and they want to make more and more money. With Pepsi, I would expect their Q2 earnings to be slightly worse than these Q1, depending on how much longer this situation goes on. Pepsi sells drinks and snacks. A lot of people are buying more drinks and snacks than normal because they're spending more time at home. You already know I got my bottle of Pepsi Max beside me. But as well, people aren't buying them as often. You know, people are stuck in their houses. People aren't going to the shops as often. People aren't stopping off in the shop before they go to work to pick up their bottle of Pepsi and their bag of Doritos. People aren't going to amusement parks. They aren't going to cinemas, places where you would spend money on Pepsi's products. So to an extent, yeah, their sales may be up because people are buying more beverages and snacks, but straight away, on the other hand, people aren't buying as many beverages and snacks in certain scenarios. But Pepsi's long-term fundamentals are still the exact same, and they are still focusing on growth. It's a no-brainer to me. I love them. As I've said in the past, I've compared them to Johnson & Johnson, Procter & Gamble. I think they're one of those big, massive companies that I will buy and hold forever. I have a full video comparing Pepsi to Coca-Cola and explaining why I do, in fact, prefer Pepsi. If you want to see that video, I'll leave it down in the description below. Check that one out after you've watched this one till the end. I need you to watch till the end so that I get a good audience retention, so that YouTube pushes the video to more people. So don't click off. I'm telling you right now, don't click off. That's it with Pepsi. Not the most excited Q1 earnings in the whole world. Let's get on to stock number 2. We're looking at Sysco Corporation, another company that I absolutely love, and they have performed very well for me so far. So anyway, they're a food distributor. They're actually, where are we, the largest global distributor of food in the universe. Okay, they have a dividend safety of 55, a dividend yield of 3.1%, and, I have to go through all of this, a dividend streak of 51 plus years, making him a dividend king. So right off the bat, absolutely beautiful. And just to complement all of that, over the last 20 years they've grown that dividend an average of 11% per year, so that is fantastic. Now what they actually do is they provide a full line of food products and non-food items to more than 650,000 customer locations. Their biggest one, okay, is restaurants, and that accounts for 62% of their sales. So obviously right now a lot of restaurants are closed down, a lot are temporarily shut, a lot won't be buying as much food as they have historically done, which is going to strongly affect Sysco. However, they are still making some money. There are still restaurants open, there are still places buying food. Obviously, they're the largest food distributor in the world. People still need their food. And we can see that over the last 5 days, they've actually gone up 14%, which is pretty crazy. And with that in mind, on the 3-month chart, they're still down just over 28%, so still down considerably. And then have a look at the 5-year chart and just look at how beautiful this company was growing for the last 5 years. We love looking at these stock charts that are just up and up and up. You already know I love these kind of charts, so it's absolutely fantastic. And there's no doubt in my mind that when the economy starts to open back up, when all of these restaurants are open back up, Sysco is going to pick up right where they left off and just keep building, keep making more money, and keep growing their stock price, most importantly. Now, Sysco is actually releasing their next quarter's earnings in only 6 days, the 5th of May. All we have to go off of, the most up-to-date information, is as of December 28, 2019. So not ideal, but it's all we have right now, okay? And what we can see is their sales increased 1.8%, their gross profit increased 2%, their operating income increased 22.3%, adjusted operating income increased 3.9%, and their EPS increased by 23 cents. So absolutely fantastic growth for that quarter. Now, of course, I would expect the next quarter to, perform a lot more poorly than that one did, for obvious reasons. They're not going to be able to distribute as much food as normal because places are shut down. It really is that simple. And that is why I find it quite crazy that they've gone up 14% in 5 days, considering these earnings are coming out. Maybe people know something that I don't. Maybe their earnings are going to be far better than we expect. I wouldn't expect them to be the best whatsoever. I wouldn't be surprised if revenue was down 25+%. But today we're speaking about these long-term dividend stocks, the stocks that we're going to invest in and hold on to for decades to come. And Sysco, their long-term outlook hasn't changed. They're the biggest big boy in the game. They've shown immense growth over the last 5 years. I mean, they're not going anywhere and they're going to keep growing. That is where I stand with Sysco. I'm very excited to see what happens when their next quarter's earnings do come out. Maybe I will make an update video when that happens, if any important news does come of it. But yeah, that's Sysco. Now, on to stock number 3. Boom, we have 3M, another company you all more than likely know. Okay, so 3M, 75 dividend safety, 3.77% yield, and wait for a 61 plus year uninterrupted dividend streak. They've actually been paying dividends for over 100 years. Yes, over 100 years. And over the last 20 years, they've grown at an average of 9% per year, which is fast, which is fantastic considering it's already at 3.77%, which is a really nice dividend for any company. Now, if you don't know who they are or what they do, they're essentially in 5 different segments. They're in industrials, which is 35% of sales, healthcare 19%, safety and graphics 17%, electronics and energy 15%, and consumer products 14%. So as one company, they're quite diversified. And again, these guys had a very nice last 5 trading days, up 9.33%. On the 3-month chart, these guys are only down 3%, so they've had a really nice and quick recovery. And again, here is where I currently stand with them on the screen, just so that you know I do own a position. Here we are on the 5-year chart, and we can see it's been quite a poor last 2 years in particular. This is something that puts off an awful lot of people, but it's always on you to form your own opinions, do your own research, and see, was it just a fumble? Are they going to recover? Or do we expect this downtrend to continue? And for me personally, I think this is just giving us a chance to get in at a cheaper price. So, their Q1 earnings, up 2.7% on sales. Organic local currency sales grew 0.3% year on year. EPS of $2.2, adjusted EPS of $2.16. Operating cash flow up 16% year on year. Adjusted free cash flow up 40% year on year. It's looking good, baby. And here is something that they're doing particularly well right now. Trump reaches respirator mask deal with 3M. US to import more than 160 million N95 respirators from overseas over 3 months. So they've seen what's going on in the world. They're seeing how bad this virus is hitting everybody, and our essential workers need these masks to be able to keep working. Recently, Trump has asked 3M to stop exportation outside of Central America, And with this, you know, some tensions have been lifted. They are now working closely with Trump. The 3M saga ends very happily, Mr. Trump said. So it's nice to see that 3M have a good relationship with Trump, because obviously if times get tough, that means that Trump is going to want to help them out. And that is essentially what he is doing right now, let's be honest. He is buying an awful lot of these masks, which are expensive, from 3M. These guys have absolutely fantastic long-term financial objectives. Obviously, this year is going to be a bit screwed, undoubtedly. I'm actually surprised that they've done so well in Q1. Who knows what's going to happen in Q2, but hopefully they do just as well. But their plan is organic local currency growth is 3 to 5%. So obviously we didn't see that this quarter, but that's okay, it's to be expected. Earnings per share growth 8 to 11%, return on invested capital 20%, and free cash flow conversion 100%. So they have absolutely fantastic long-term goals. Any company that's been paying dividends for over 100 years and has grown that dividend very nicely for the last 60 plus years is, you know what I mean? It doesn't get much better than that for a long-term dividend investor. It really does not. And I know it's been a bad last 2 years, but if we just look at the max stock chart, those 2 years and the Great Depression aside, it's been absolutely fantastic growth. That was company number 3, was 3M, one that is probably on pretty much everybody's watch list anyway. So on to company number 4, AT&T. A lot of people have strong opinions both for and against these guys. I am personally on the side of for these guys. They're the biggest telecommunication guys that there is over in the US, and I like the big boys, okay? So a dividend safety of 65, a dividend yield of 6.6%, they have come out and said that they believe that dividend is safe, and also an uninterrupted dividend streak of 36 plus years. Now, this has been growing very slowly, as we can see here. The last 20 years, 4% growth per year. That is slow, but with that in mind, it's at 6.61%. So it's a massive dividend. You can't expect them to grow this particularly quickly. A good week in the stock market for these guys, up 6.7%. Not a red day in sight. Nice sign. 3 month change, only down 15%. So again, not terrible by any means. This is where a lot of people get worried. We look at the 5-year chart and it's been quite poor. All in all, this was largely down to lawsuits. So essentially what happened was they misled their customers with promises of unlimited data, and they had to pay $60 million to resolve the FTC allegations. Like, I know this hit them obviously very hard, but it's something they can most definitely recover from. It definitely threw a lot of investors off. It made a lot of investors sell. For me, I'm fine with it. You know what I mean? They're going to bounce back from it. 3 things to take away from their Q1 earnings report. 5G pricing has profit potential. I think everybody knows that. We don't need to get into that too much. It's not affecting things too much as of right now, but it could potentially make the money down the line. Now, Warner Media is delivering the goods so far. That's what we want to see. Obviously fantastic. AT&T dropped a whopping $85.4 billion to acquire Time Warner in a deal that closed last year. It's been good news so far. Sales are up 3.3% and operating income rising 11.6% from a year ago. So, very good investment on their end. One more thing is that debt reduction is on course, which is fantastic in unprecedented times like these. Companies have to fight to survive. Now, AT&T is the biggest of the big boys. They're going to survive. There's no doubt in my head about that, but we still want to see these good signs, these debt reductions, the companies taking the measures, taking the precautions that have to be put into place to survive. AT&T obviously added a lot of debt after it bought Time Warner, pushing its overall debt level to 180 billion. But as of right now, by the end of Q1, they had cut its net debt low to 169 billion. So with everything that's going on, they're still paying back their debt, they're lowering it, and they're confident that it will get the number down to around 150 billion by the end of the year. So they're handling their debt very well. That debt that they took on to get Net Warner was good, you know what I mean? It's making them money. That's what needs to be done. I understand the worries people have about these guys, the lawsuit, the inconsistencies over the years, but from a long-term outlook, I really like the look of them. And that 6.61% dividend yield takes away a good bit of the risk that is associated with them. Me, I do own a position in them, here it is, and I do honestly plan on buying a good bit more in them just because that dividend is so attractive and I believe in them. And now, the very last company of the day, Johnson & Johnson. They need no introduction, you all know who they are. A dividend safety of 99, a dividend yield of 2.7%, and an uninterrupted dividend streak of 57 plus years. These guys are in the pharmaceuticals. Very recently, they hiked their dividend 6%. That dividend is very safe, and they're deemed by an awful lot of people to be one of the safest companies in the entire solar galaxy universe. They're in pharmaceuticals, which is 50% of sales, medical devices, which is 33% of sales, and consumer products, which is 17% of sales. You more than likely will know a lot of their products: Tylenol, Listerine, Benadryl, Johnson's, Aveeno. You more than likely have some of these in your house and use them on pretty much a daily basis. Now, funnily enough, the last 5 days haven't been the best. They're actually down pretty much 2%, but the last 3 months we're only down not even 0.5%. They've already come back up to their highs very quickly. And if you would just have a look at their max stock chart for me, it doesn't get much better than that really, does it? Having a look at their Q1 results. So their first quarter 2020 sales up 3.3% worldwide. Diluted earnings per share up 56.1%, adjusted diluted earnings per share up 9.5%. So the Q1 report came out, it's all good, and it goes to show like their stock price is essentially fully recovered and now can just, you know, hopefully go to the moon. That's what we want to happen with J&J. The last time we saw any sort of a real dip was the Great Depression, and just look, it wasn't even much of a dip and it boomed back up to the sky, and I would expect over the next 5 to 10 years they will boom up again, and over the next 20 to 30 years they will just continue to boom forever. So guys, they are the 5 stocks that we're going to be covering today. If you watched till the end, please hit that subscribe button right now. We're so close to 2,000, it's absolutely crazy. With all of the exciting stuff that's going on right now, with all of the 60, 70, 80% discounts we're seeing on certain riskier stocks right now, it's important to remember, especially if you, like me, are a long-term dividend investor, not to get too distracted with these really attractive looking stocks. We're trying to set ourselves up for lives. We're not chasing 500% growth in one day. That's not what we do. We like to pick the safe stocks that will ultimately pay us very, very nice dividends in the years to come, and will give us a good return on our absolute share price as well. And look, just like the next guy, I like playing around with some of these riskier stocks. The high growth potential is extremely attractive, and there's nothing wrong with having, you know, 10, 20% depending on your age, depending on your risk tolerance in these higher risk stocks. But don't forget to have the majority of your capital in these safer stocks if that's the kind of investor you are. Just because most of the people on YouTube are speaking about Carnival and Delta and all these other high risk plays doesn't mean that you have to, you know, start investing in them. But anyway, if you watched till the end, thank you so much for the support. It's been absolutely mental on this channel lately. I say it on every single video, but it really just is mind blowing to me. So again, thank you all so much. Please like the video if you haven't just yet. Drop me a comment below with your thoughts. Help me out in regards to the YouTube algorithm. And until the next video, guys, peace.